Thanks for tuning into BQ Conversations. I'm your host, Nihad Shah. We're trying to speak to some of the most senior people in the investment fraternity who look at the world at large and try and tell us how they see India within that landscape. Our guest today has tremendous wealth of experience. He served on the World Bank's board, managing assets nearly $60 to $70 billion before he joined Carlyle and eventually co-founded RockCreek's Group, which manages about $17 billion worth of assets spread over various countries. Mr. Sudhir Krishnamurthi joins us right now on the show. Mr. Krishnamurthi, thanks so much for joining in. I'm tempted to start off by asking you about whether investors should expect any kind of major returns in risk assets in a growth-starved world where interest rates are rising. How is it even possible? And therefore, would earning large returns from equities be a distant dream?
I think you're right. As the saying goes, if the US catches a cold, then everybody else has a fever. So, and that to a large extent, I think is still true. The US has been going through a fairly difficult inflation process. It has had a lot of difficulty in getting its inflation under control. The whole of 2022, you saw record Federal Reserve rate hikes. That doesn't seem to have either reduced or tempered the amount of inflation in the country. And consequently, we can still see a significant amount of tightening left. There was some euphoria earlier in January. People thought we were closer to the end, but now those have all been dissipated in February. And I think we are at the moment thinking of a very long drawn out rate increase cycle. And that will have implications for the dollar. That will have implications for US liquidity in US markets. And consequently, it will have a lot of implications for countries in emerging markets, including India and places like China.
Could this be a slightly more protracted period than what the world may anticipate? Because frankly, almost everybody was thinking of peak rates in come Jan, Feb, March. And we now know that that trial balloon has been punctured and it's been postponed to at least 2024. And who knows what happens then. So is it possible to gauge what the extent of this period of higher rates, lower liquidity could last for?
Absolutely. In fact, the expectation was that somewhere around a 5 handle, which is a 5%, would be where rates are likely to top off. That was the going in assumption towards the end of last year. That's been, as you rightly pointed out, punctured. We are now even thinking, many people have started thinking about a 6 handle, which means that even if they go in for rate hikes, they're in for rate hikes well into past the summer and basically into fall. So most of 2023 will be a rate tightening cycle. And that means that is going to exert a lot of pressure, I think, on US equities. In fact, we have seen the sell-off in February in US equities and globally. And that we think will likely to continue because inflation is still, if you look at the typical consumer price indices and other inflation metrics that the Fed uses, you will see that they have all still been well above acceptable norms. We're talking about 6% plus. So we have a long way to go to bring it down to a reasonable level. And if you look at the structural reasons, and we can talk about that, I think it's going to be a little challenging for the Fed to bring it down. And they are being extremely hawkish. They obviously did not come out looking very good in the earlier stages of the rate hike cycle when they felt that it would be transitory. But now that they've started it, they are very, very determined to stamp it out and bring it down. And even if they get it down to somewhere in the 4 handle at the end of this year, I think it will be a minor victory for them.
Some people would argue, Mr. Krishnamurthi, that the real bad setup for duration risk would not be the US recession, but the lack of it. Because if that were not to happen, and if rates stay higher for longer, and if over a period of 12 to 18 months, if inflation does come off because of base effect, because of slowdown, what have you, then that's actually really bad for equities per se and over a protracted period. Do you foresee such an event, or is it an outlier?
No, I think US growth equities, you see, if you look over the last so many years, equities, especially growth equities, the growth sector in the US has been the dominant reason for the drive up in valuations in the US markets, especially the S&P or any other index that you choose. The top 5 or 6 have accounted for a very significant portion. All that, anything which goes up like a bubble will have to come down, I think. And I think we have a long way to go to bringing it down. And I think they will come down. There is what is called, when you burst a bubble, the bubble bursting does not result in an orderly decline in prices. Whenever they decline, there is what we call an echo effect. That is, they go down and then there's a rebound. Then they go down and then there's a rebound. And usually a good bubble like the tech bubble in the US will result in something like 4 or 5 echoes. If you look historically, that's what has happened. In fact, there are papers written on this by some well-known writers. So I think you're going to see that, and you're going to see that through all of 2023. There'll be the fake, the head fake, as they call it, when it bounces back and then it comes down. So I think we'll continue to see that, and you will see technology growth stocks coming down. And when that happens, you will see the consequent reverberations in the rest of the global economy as well. And that includes India.
Wow. Okay, I want to understand those implications too, but just one quick follow-up macro there, Mr. Krishnamurthi. Post GFC, there's this belief of a new normal of lower rates. Now, does that get challenged? While there might have been new normal for 13, 14 years, maybe it wasn't a new normal. And maybe we go back to rates not being as low as they were ever again in the distant future.
Probably not. I think you have made a very good point. People felt we had got inflation out of the system. And so you could have rates at very low levels for an extended period of time. So you could go into long duration assets like equities very, very easily and make a lot of money. And that's happened. In fact, if you look at over the last 20 years, starting from, I would say, the dot-com bust in 2002 to something like even 2010 and 2011, that was the period of the emerging markets. That was the commodity boom for those who follow these kinds of things like we do. And then 2011, 12, it was the technology here in the US. And if you now look over the entire period from 2002 to 2022, half the period, emerging markets did very well. Half the period, the S&P did very well. But net over this entire period, both of them have returned approximately the same return. It's not very different. There's a plus and minus a little bit, but orders of magnitude, they're very similar. So we are now at a point where we were in 2002, both for emerging markets and for the US. Going forward, the question is, where is the next bounce going to come? And I would say the stars are better aligned for emerging markets because they are the ones which have taken, their valuations are at levels which now make it much more attractive than it is for developed markets. But only the future will tell, but that is the perception.
And you do believe that equities by and large would still over a period of the decade give good returns? Because there is a fund manager in India who in an interview told me that it's time to move from Tina to Tara, something that Howard Marks said that yes, most certainly there are reasonable alternatives there. So my question is, in the order of preference, over the medium term, do you still believe equities hold center stage, emerging markets as they may be, or do you believe fixed income has a fighting chance of being a dominant asset class?
No, I think eventually, if yields go up as they will, I think, or remain high, as you rightly pointed out, it continues to have a fighting chance. It was a no-brainer over the last 10 years to be even, long fixed income. Yields were coming down, you made good money, and everything was good. Now, of course, the interest rates are going up, so fixed income becomes a little bit more challenging, I think. But having said that, yields will be good. I think we are now thinking about 2-year rates in the US at 6%. So that's not bad. And then if you take credit with add-ons, whether it is in public credit or private credits, and you take the necessary spreads for high yield and investment grade credits and things like that, you're looking at numbers which are reasonably attractive. So I think fixed income will have a place. But I think at this particular point in time, not knowing when inflation will end and when the rate hike will end, it's a little risky at this point to start going into long duration.
Okay. Now I'm shifting to the point that you made that maybe emerging markets have a better chance because the valuation argument is in their favor. I would reckon that it may not hold completely true for India because India valuations are never cheap. But then India is always traded expensive. So tell us, how do you look at, the basket as we speak, the emerging market basket, and how do you look at India within that basket?
You make a good point. India is never cheap. In fact, I would say it is by far one of the most expensive valuations in the emerging market basket. I think, I don't know the current level, but it's somewhere, I think it's currently trading somewhere in the 23, 24 range, but the exact number I don't remember. So whereas if you look at the MSCI index as a whole, the whole basket, I would think it was trading somewhere in the 12 times. So it's twice as expensive as the index as a whole. And then there are countries like Brazil or even China today. Brazil is trading, I think, at 6 times. And China is trading maybe at 15 times. And so I think there are a lot of alternatives to the Indian market. India had a very good run, relatively speaking, in 2022, I think. And a lot of foreign investors, which included us, we were overweight India through most of 2022. And we're rewarded for that by returns which were negative, but still significantly better than what we could have got in equities elsewhere. The question is, where are we today? And given that valuations in other countries are a lot less, especially we have many attractive alternatives today. China being one, we can talk about that, or North Asia in general. And we can talk about LATAM, which includes Brazil and Mexico and places like that. So there are different pulls away from India. So if you'll see most financial, the way that most foreign investors look at is on a relative basis. If they decide to go into emerging markets, that's the first decision. A second decision is within foreign markets, within emerging markets, which are the countries that we like and which are the countries where we are a little bit wary because of valuation, political situation, macroeconomic environment. There can be a number of reasons. India, people are not, do not feel negative about Indian equities per se. They just think it's too expensive. So just like you wouldn't buy a very expensive car, you may go in for an alternative. It's a very similar kind of a situation. So we try to see, can we make the same amount of money buying cheaper stuff than we can being in India? And that's basically how the thought process is. So what happens in that kind of an environment? I'd say we, and I'm sure many of my peers in the foreign investor community have, I'm sure, redeemed a fair amount of money over the last 2 months, and rightly so. And we can get into, there are some macro reasons, there are some sentiment reasons, there are some growth reasons. There are so many reasons why you would cut your holdings in India, and that's what we have done. And we have redeployed it elsewhere within emerging markets, given that we want to to have a certain exposure in emerging markets.
Lovely. So I would love to probe that. So I presume you are saying that over the last, say, 6 to 9 odd months, you would have taken some money out of India and used that money to deploy in other emerging market asset classes.
That's right.
Okay. And I heard you say that there are 3 groups of reasons which lead you to do this. Can you talk a bit about that, please?
Sure. The first thing is the growth. India had a fairly good growth rate in GDP last year, but that was, I think you alluded to earlier in your comments, that was primarily due to the base effect. The base effect obviously helps, so you see a big pop in growth. But when you look at the growth GDP growth rates coming out in for fiscal year Q3, I think was the number I saw last. It was somewhere in the 4 handles, 4 something, if I remember.
Yes.
So that is not very promising. I mean, if we are going to be looking for growth, when we invest in emerging markets, it's for growth. We invest primarily in equities. In fact, in emerging markets, we seldom invest in credit. We don't go for debt. We don't go for credit. We go for equities. Because if I'm going to take the country risk and the political risk, I want to be compensated, and therefore I want the equity returns. So that's basically the thought process. So 4.4 just is, and also the currency is not in a very strong position at the moment. I mean, the RBI has got into the market operations to keep the rupee relatively stable. But it has depreciated. It has depreciated less, undoubtedly, than many of our peers, many other countries, but it has depreciated. But at this particular point in time, with inflation still being high, unless they raise rates, which will be negative for equities, or they let the currency slip, both of which will be negative for an equity investor. So growth is low, the currency is not strong, the RBI has a tightening bias, and the consumer is not very strong. That's the fourth reason. And if I could have a minute elaborating on that, if you look at the Indian consumer, I would divide it into 3 parts. There is the first part, which is about 50 million people, maybe give or take. And these are the guys who got through COVID. They got a lot of money. They are the people who, not all of them, but many of them will buy a Mercedes-Benz. I'm using that as an analogy for luxury goods. And so they will go out and buy expensive stuff, and they are not bothered about a little inflation here or a little inflation there. Their balance sheets are in very good shape. Then you have the next group, which I would say is the true middle class in India, which has maybe an average annual income, household income, maybe 10 lakhs, 8 lakhs, 10 lakhs. Most of them are in rural, second-tier, third-tier cities. And this group is the one which has had the balance sheet affected the most. And they are a very significant fraction of consumer spending in this country, because by sheer volume and size. So there are 300 million people or so, and they have to spend the money. Consumption accounts, in our opinion, for 65% of the total GDP of this country. If that group, which is that 300 million, are not spending money, consumption is going to go down. And by corollary, growth is going to go down. We do not see any improvement in the balance sheet. We see some improvement, but those balance sheets are still not done. We have not seen any harvest, any good harvest, food production, because a lot of them could be agriculture oriented and so forth. So we are not seeing that. Moreover, we did not see any stimulus in the last fiscal budget to help that particular group of people, or not substantial. So I think that group is still a little under the weather, so to say. Until that happens, I think you will see growth in India slightly more sluggish. So if growth is not going to be there, and the valuations are high, and you see a macro environment in which the central bank will have to be in a tightening mode and inflation being high, it may be good to take some checks off the table. And that's basically what I alluded to. So most people would not, and there's a sentiment reason which I don't need to go into. where there have been some negative publicity about the Indian equity market, and that has not helped. So foreign investors, when they see smoke, they immediately think fire. And so they first, there's a saying in the US, shoot first, ask questions later. So this is one of those kinds of situations where you see something, you immediately react. And so there's been a lot of negative outflows from India over the last few months. I'm sure you've seen that as well.
Yeah.
But I think all that will stabilize, all that will go well, and people will come back and people will invest in Indian equities. But I think where they will invest in equities will be at their benchmarks. They are not going to take an outsized position in India. I mean, they may be slightly up or slightly down, but if I were to take the average, that's really where they would remain for some time. They'll want to wait and watch how sentiment improves, how growth improves, how inflation situation improves. And of course, there's always the election coming next year, and hopefully everything will go well. But those are the kinds of considerations that people keep at the back of their mind when they think about investing.
Okay. I'd like to play devil's advocate on a couple of points that you made,
Sure.
Mr. Krishnamurti. One of them about helping the middle income or the lower income groups via budgetary allocations, and the view that largely came out from some fairly intelligent people who watched the budget closely was that it is a good thing that the rural consumer or the semi-rural consumer was not given freebies, because that would have been temporary and that would have been inflationary at a point of time when you don't need inflation. And therefore, a long-term sustainable method of boosting rural income through infrastructure spend was the tool utilized, because infra income constitutes a large portion of the rural balance sheet as we speak. Why was that incorrect, sir?
I think you're absolutely right. I mean, if one had to look at it purely from an economic point of view, everything that you said is absolutely true. But the only problem with infrastructure, I mean, India needs infrastructure. I mean, we see that in Chennai as much as I'm sure you see it in Bombay, which I did, and in Bangalore and places like that. So we do need a lot of infrastructure, and the government priorities are right. I'm not for a moment questioning that. But the problem is infrastructure spending is slow, and its ability to reach the consumption basket is very slow. So you are not going to get any boost in growth during a short period of time through infrastructure. And so you want to first get, it's like, do I need to build a house or do I need to buy food? If those are the questions, I first have to buy food because I have to live to be able to live in the house. I mean, I simplify. And so you really need to get that 300 million people in a very, very good position.
Sure.
If you look at the US, that's basically what they did. Of course, it's been inflationary and maybe they overdid it, but you cannot underdo it also, because that is a group which matters most for stability, politically, economically, socially, and you want that group to be happy and contented. And any disruption there can have consequences more than one would imagine. So, I mean, that's my personal opinion. But
sure, of course,
it will run for my experts. That's what I think.
Which is what we want to know in this interview. The other part, Mr. Krishnamurti, is that for better part of 2021 and 22, and even this year at the World Economic Forum, nobody could have enough of India. The call came out that China for China and India for India and India for the rest of the world. So my question to you is, and you kind of alluded to that things will stabilize and things will return. But my question is, for a country which was touted to be the next factory of the world, if you will, services capital of the world, and an alternative to what is currently the factory of the world, so to say, should growth, the long-term or the longevity of growth, never mind the short-term hiccups, be not something that will make people believe that it is expensive, but it's fine. It'll probably remain expensive.
I think you're right. We share a very similar philosophy. And I think we think, I wouldn't go to, maybe it is being over ambitious to say that India will replace China as the
of course not.
Far from it. I think we are very, very far away from it.
Yeah, agree.
The sooner we get ourselves comfortable that we have a different role to play and China will have a different role to play, I think the better it will be for the globe as a whole. But we have a lot to offer. We have a lot to offer. We tend to be much more entrepreneurial as a country. They are very good at taking an existing product and manufacturing it at the lowest possible price for the globe. That's what they are good at. And we are very good at creativity and new products and a lot of entrepreneurship and things of that nature. So it's a very different kind of an ecosystem we have from what they have. And I don't think we should do what we are good at, not what works for somebody else. But given that, if you see, in fact, we have actually, while we do still a fair amount in public markets, and I'm talking about us as a firm, we have definitely branched off quite significantly into both private equity and more significantly into venture capital, because that's where we think the future of this country lies. Because the venture capital, when you go around and meet up with some of the new entrepreneurs in places like Bangalore and others, it is incredible what they have managed to accomplish or what they are hoping to accomplish. And this is across a wide variety of industries. In fact, if you look at I'm sure you know the statistics much better than I do, but if you look at FDI flows into India, you now find that FDI flows into India, which I would group venture and private equity in a very broad sense. In the earlier days, FDI flows used to be directed to maybe half a dozen industry sectors. Last year, it was directed to about 60 different industry sectors. So that whole ecosystem of giving private equity, direct investment, venture capital is now permeating through the whole system, which I think is going to be extremely good for the country and for because I think Indian foreign investors will take up that and invest in private equity and venture capital will do very well for themselves, because these are venture capital and private equity 20 years ago had a bad name in India because the market was not well developed. They were minority shareholders. The foreign investors did not get what they thought was their due. The markets were not deep enough to do IPOs. All that has changed. We are now a much bigger $3.5 trillion equity market, a lot of IPOs, a lot of unicorns. So there's a lot of optimism about the venture capital world investing here in India. And I think that is the future. Of course, we have to keep a deep equity market because venture cannot sustain by itself. But even though we may be neutral on the equity market, we are definitely overweighting our allocations, especially in venture and private equity.
Got it. Well, maybe a world of alternatives out there as opposed to only equities for India. I have one question though, and which is, how do you view the development over the last 5-6 years of such a large portion of Indian money going into Indian equity markets through indirect routes like the EPFO and otherwise, and directly through mutual funds and even direct equities for that matter? Because earlier, Indian markets used to be completely at the mercy of foreign flows. We're now starting to see that behavior change a little bit. So how does a global large money manager look at that aspect? Because you may never find India to be very cheap because Indian money is out there nibbling at every lower level.
Yeah. You make an excellent point. I should have made that much earlier. I think you're absolutely right. In I think foreign institutional investors may be about 20% of the Indian market. So out of the 3.5 billion, maybe 3.5 trillion, maybe they're about 600, 700 billion dollars. But the point is, but they tend to be marginal buyers. From a free float point of view, they are much bigger than that because a lot of 3 trillion is all which are not directly traded on a regular basis. Because being a marginal buyer, they obviously do have a very big impact on most equity markets and emerging markets. That used to be true for India. That's still true for many countries, Brazil and to a certain extent other. China is a different cup of tea, but many other countries. So they did make a very big difference. But now what we find is even if the institutional investors leave, the Indian investor tends to be very stable and the flows are very, very strong. And the Indian investor luckily has a very small allocations to equities at the moment, relatively speaking. So that has quite some legs and some way to grow. And therefore, I think you will see a lot more stability. So the days in which foreign investors, I think if I'm not mistaken, may have taken out anywhere between 5 to 10% of the Indian market over the course of the last year or two. That amount would have had a very, very big impact on the stock price, but the market did not move quite as much. That is what you need from that. I mean, when people say the S&P 500 is liquid, that's what it means. You can take in money, you can take out money, the market doesn't move. And that's the situation you eventually want to be in. And I'm sure we'll be there.
Got it.
For 10 years, if we have this conversation, I'm sure we'll be in that position.
I'm sure. My final question. I'm suspecting that you are currently constructive markets like China and a few others versus India. What would change that in manner of relativity? I'm not saying in absolute terms the roles would reverse or the view would reverse, but what would change? Would it be a decision taken post May 2024 because political heavy calendar might make it difficult? Would it be growth factors and growth coming back, or how would you change your call on Indian equities currently?
I'll make one small correction to what you mentioned. We were through the COVID closures in China, we were quite underweight China, quite underweight. So when I say we have become more constructive in China, I don't want to give the impression that we are getting to be overweight China. We are not. We're still a little underweight China. We are coming closer to neutral than we would have been, say, about a year ago. And the reason for that is obviously the reopening trade is good. But China, if I could spend a minute on China, which I think is interesting also. The thing about China is this time the recovery will have to be driven entirely by consumers. It's not going to be investment-led as is traditionally the case for most China recoveries. And that is because a lot of that monies which were spent as a fiscal stimulus used to come from local governments. I'm not sure how much you follow closely, all of you follow this, but a lot of that money on infrastructure used to be spent by the local governments, which used to raise the money by selling land. So the typical process would be there'll be a small local municipality or a thing which will have a lot of land, which they will sell to property developers who will give them money. And that money is what they will spend into infrastructure. That's how the system worked. There were some, of course, some of it was done at the central level, but a lot of the recovery happened. Thanks to the COVID, lands, and of course, many of you might have followed the developments of property developers in China, yes, which was very, very negative. Because of all of that, what in effect happened was the local government, during COVID, there were no sales of land. Nobody was buying, nobody was building. So they did not have any revenue with which to support themselves. In fact, Many of them are having great difficulties in even paying their staff. Staff salaries have been reduced in many local governments because they just did not have the money. So the question is, and under these circumstances, and we can go into length, I don't want to get into too much detail, but for a variety of reasons, it's not going to be investment-led. We think it's going to be consumer-led. But even in a consumer-led recovery, China has a problem because they have some amount of savings during the COVID, undoubtedly, which pent-up demand and things like that. But they have a problem which is called, which all of you are familiar with, the wealth effect. A lot of the wealth of individual consumers in China was based upon their housing. Unfortunately, those house prices have depreciated significantly in value thanks to the property crisis. So the wealth effect means that these Chinese are no longer willing to spend quite at the same level and same rate as they used to in the past. And their salaries are not going up because local governments are still strapped, and you're not seeing a lot of private investment in property development. They've stabilized it, but there's not much investment. So long story short, there will be consumption improvement, but it is not going to reach the levels that it did a few years ago. So we must be a little cautious, I think, when we say, and it's consumption driven. So we don't directly invest heavily in China because a large part of it is state-owned enterprises, which we think have low PE multiples and not much opportunities for growth. So it's only the private part of it. So we have to be a little mindful of that. But the way you play China is through the ASEAN region, because Chinese consumption will take effect in the form of tourism to countries like Thailand and Philippines and the like. So we play it through the ASEAN region rather than directly through China. Or we play it through Taiwan, which is a better bet because of supply chain linkages with China rather than China itself. Yes, we are constructive on China, but given all the other considerations, we try to play it through other opportunities.
Fabulous insight. But therefore, I'll just extend my question then, my final question, which is that therefore, what would make you change your positioning on India relatively, even if it's at the margin? Would it be passing of the election year or what else?
Yeah, this is going to be a little bit, 23, I think, will be a little bit of wait and watch here, at least for us. We will watch what happens, how consumers are reacting in India, especially the group that I talked about. Is growth rates of GDP ticking up, or are they flatlining? Is the currency relatively stable, or are we seeing continued weakness and higher pressure on higher rates on the RBI? And of course, so by the time all that we take stock and get a sense of how it is unfolding, we will be looking to the elections next year and seeing how the political parties are faring, and whether the continued political stability, which we expect. But one must, as an investor, always be prepared for what we call the black swan event. So you want to keep all that at the back of your mind. So this will be, I think, for India, at least as far as many foreign investors are concerned, it won't be that they're not pulling out wholesale, but the marginal dollar, I think, will go somewhere else. And they will be a benchmark, and if they are slightly overweight to benchmark, that's fine. They may start getting into a little bit more private equity, private markets, and things of that nature. And we're seeing a little bit of that. But if things all pan out the way we hope and expect, then I think you will see the next leg up, especially if more monies are being deployed into emerging markets. Then you should see India being a beneficiary of that in 2024.
Got it. Well, this is lovely. Thank you, Mr. Krishnamurthi. Splendid talking to you and understanding the facets from a large foreign investor's perspective on multiple things, including the Chinese insights.
Thank you. You've been very kind.
Now, the pleasure was entirely ours. And viewers, thanks for tuning into this conversation.